Yeah, before I begin, and before I forget, because this is also important, just to throw out as you think about MJ REIT, we traditionally have a $25,000 minimum investment for entering the fund. However, we have an exclusive offer through IRA Club where we did lower that minimum to $10,000 for new investors. And you might think to yourself, well, why do that? Well, first, we have a fantastic partnership with IRA Club, and secondly, when you think about the ability to dip your toe in, you can allocate 10,000 to the fund, watch it for a few months, 6 months. You like what you see, you like how the interaction is, you can always increase that investment. But by offering a lower entry point, we think that we can provide exposure, which we feel is makes sense for most investors' portfolios. Not all, but most. And if you want to dip your toe in the water, certainly just pay attention to that
Chris,
10,000.
honestly, I thank you because I had no idea you were gonna do that and offer that till like right now. So, thanks. And you might have had that conversation with Kasha, head of sponsor
Yeah.
care, and Xavier and the rest of the team. But great. So yeah, that's a positive for all you IRA Club members that are listening. So, thanks for the offer and thanks for the partnership.
Yep, absolutely. And boom, I just flipped now. Hopefully you see a bunch of legalese. Just know I'll sum it up by saying that that all investments are exposed to some level or degree of risk. So make sure you understand the investment offering before allocating capital. And hopefully I did the compliance justification by going through a quick review there. All right, so what are we going to do today? I really wanted to break up today's presentation into four different distinct areas. And first, we're going to talk a little bit more about why consider alternative investments for your portfolio. We'll spend a little time digging into some of the details around that. Then we'll discuss how private real estate can help with that diversification. And then the bulk of our time will be spent really on understanding the unique opportunity within the cannabis real estate market. So we're going to dedicate some time there. And then we'll close with MJ REIT, a quick overview, and if it makes sense for your portfolio, certainly welcome the opportunity to jump on a separate call, really explain all the nuances, risks, and benefits involved with the strategy, and whether or not it makes sense for your own personal portfolio. So why alternatives? And this is something that, again, kind of going back to the IRA Club, that you do a great job on providing investors with different opportunities on the IRA platform. And why would somebody consider alts overall? Well, as I mentioned earlier, I spent the first 15 years of my career in the public market side. And while I believe public equities and bonds have a place in just about every investor's portfolio, if you're not including alternative investments or private assets, you're missing some of those additional benefits. And those benefits are very clear. One is the fact that alternative investments can provide additional diversification for your portfolio. It can substantially, or it has the potential to substantially reduce volatility. And also you can earn better, or have the potential to earn better risk-adjusted returns. And whether that's returns derived mostly by income, or even on, say, a private equity or a venture side, multiples of what your initial investments are. And so those are really the big three that I tend to look at when I consider including alternative investments into one's portfolio. So you have diversification, volatility, and returns. And there's an interesting statistic out there that if you look at the US, and specifically in the US, all of the companies that we have, there's about 96% of the companies in the US are private, and the rest being public. But if you were to look at bigger companies with 100 million or more in revenue, 86% of those are private, and 14% are public. Now, why is that important? So back to the public versus private, if you have your investment portfolio allocated solely to that 14%, well, quite frankly, you're missing opportunity in a lot of other areas of the US marketplace. And then even on the right side of the screen, I'll break it and take it one step further. If you look at those really, really big companies, companies with $1 billion or more in revenue, 18% of US companies have $1 billion or more in revenue. And out of that, 11% are private versus 7 being public. So it just kind of paints this picture that if you're allocating solely to public companies, you're missing the potential for enhanced returns, diversification, and reduction in volatility through private companies. And I won't belabor this slide because it really talks to different alternative investments. Many of these are available on IRA Club's platform. Just to list a few here, whether it's from real estate, hedge funds, private equity is a big one. I have a bunch of my own IRA assets in private equity. Yes,
Not
Ramos, that's your hand.
collectibles. You can't do collectibles
No,
within
no,
your
not
IRA 401k to confirm. So just to make sure you guys are listening.
correct. Yes. Can't do collectibles inside of the IRA, but some of these other areas, they are available and you can hold those. So just kind of understand what's available, but just from a high level standpoint, different examples of alternative investments, and they can range in different types. And each one of these have different outcomes when you look at real estate, hedge funds, private equity, etc. So why private real estate? And I want to spend a second going through the private real estate opportunity. And if you look at real estate in the US, real estate is the third largest asset class in the US behind fixed income and stock. So it's a massive market, estimated to be over $24 trillion in size. So it's a really, really big opportunity. But unlike fixed income or stocks, which are really focused on either income oriented or growth oriented, in private real estate, you can actually have an income and growth oriented stance because you can generate or capture income from rents and you get the appreciation from owning the property. So it does have those characteristics that blend kind of the fixed income and the equity side together into one investment. But getting back to private, if you look at the way most investors will access the commercial real estate market, it's on the private side. Private versus public. So if you look specifically at real estate, 94% of the exposure is in private real estate, with 6% of that being in public real estate, which is typically public accessed anyway, which is your public REITs on the US exchanges. And then from an investor allocation standpoint, individual investors tend to be under allocated to private real estate, holding less than 3% of their overall allocation versus public pensions and larger institutional clients that have 10% or even higher. So the opportunity is there to take advantage of. And we're looking forward to getting to a little bit more detail on the opportunity within specifically the cannabis area. So why else? Why else would you consider allocating to real estate? Well, number one, it's been less so. I think the Fed came out today. They were supposed to lower interest rates, or it was expected that they lower by 25 basis points. I haven't seen the newsprint yet, but most likely, at least that's what the market predicted. But in an inflationary environment, real estate has tended to perform very well and actually protect or increase over time. So you get a inflation hedge, if you will, by investing in private real estate. And you get a consistent income along the way. So what I'm showing here is you look back over the last 20 years, and in private real estate, what the annual income distribution has been over that 20-year time period. And 16 of those 20 time periods, you had income that was 4% or greater. For those years with income between 3 and 4, and interestingly, 0 where you had a year with a less than 3% income component. And sitting here today, you look at where the market is, where the 10-year treasury is, income is getting harder and harder to find, especially as the Fed continues to cut short-term rates. And so MJ REIT, as we will discuss, is really focused on plugging that hole so that investors can have a different way of generating that monthly income. So we talk a little bit about this idea of private real estate and the benefits of private real estate. And now we want to look a little bit closer at what I'll loosely define as specialty real estate. And specialty real estate, and as you can see on the top left of your screen, highlighted in green, cannabis falls squarely into that bucket. But there are other types of specialty real estate, whether you're looking at parking garages, movie theaters, medical centers, historical buildings. So there are other pockets of specialty real estate, and there are investment strategies out there that you can gain exposure to these areas. But specifically in MJ REIT, we focus solely on financing commercial real estate within the cannabis sector. And so that's where we're going to spend the bulk of our time today. So why do we like the cannabis markets? When I got into the private markets back in 2009, I worked at a firm where we launched the first private BDC. And BDCs are essentially, they stand for business development companies. At their essence, they seek to provide capital to either small public companies or private companies. And what made them so successful at the time was there was a huge demand for capital and a lack of capital available. So you fast forward to where you are in the cannabis space today, the demographics are quite extraordinary. So you have within cannabis, the fastest growing industry within the US. So you have very strong growth characteristics. You have a lack of traditional financing, and that's due to the illegal status on the federal level. And you have limited institutional involvement. And generally, when you can find one, two, or all three of these characteristics present in a specific sector, you can create a strategy or generate better risk-adjusted returns than other strategies in the marketplace. And so, again, think about the strong growth characteristics, the lack of traditional financing, and the limited institutional involvement, which is really the reason why I chose the cannabis space to launch this strategy. And I'll talk a little bit more about that in detail in just a moment. So from a landscape, we continue to see an expansion in the market of which states are legal and what states are not legal. So just to level set, today there are 38 states, DC, and a few US territories that have at least a medical availability within those states. In yesterday's election, 4 states were looking to move from medical only to also include what we'll refer to as adult use or recreational cannabis. The biggest of those 4, which were North Dakota, South Dakota, Nebraska, and Florida, was Florida. And so Florida, unfortunately, did not pass, so they still remain a medical only state. North Dakota, South Dakota also stayed medical only, but Nebraska did pass, so they will go to a recreational or adult use basis. And why is this important? Well, it's important because cannabis is still illegal at the federal level. You need to grow, process, and sell cannabis within the individual state because you can't cross state lines. So when a state like, for example, Florida, should Florida go adult use, you have a larger addressable market that creates additional demand for the real estate that's required where you grow, process, and sell. And then on the fund side, we see an increase in the opportunity to deploy capital into very attractive markets. Today, inside of the fund, we have exposure to 25 properties across 5 states. So we are in California, Colorado, Ohio, Michigan, and New York State. So we'll traffic in any state legal jurisdiction. And then from a state standpoint, you think about why states would potentially move to a adult use program, and really it gets down to the money. States last year on a national basis took in $4 billion in state tax revenue. And that's state tax revenue that can be used for social programs, roads, schools, expansions. So it's very attractive for states to move to a recreational basis so that you can generate additional state tax revenue to fill those budget gaps. And last point on this, when you look at 2024, I have down here 11 states. There's potentially 12 states that will exceed $1 billion in cannabis sales in 2024, which is just a massive, massive number. Ramesh.
Chris, I don't know if you know this, but so in one of our real estate properties, my father's brother owns a cannabis company called Accent. I'm sorry, they lease to a cannabis distributor called Accent. The guy showed me the taxes that they're paying. To your point, it is absolutely absurd what they're charging. I think it was like a 33% tax in the state of Illinois for cannabis, the purchase of cannabis. Forgive me for money.
Yeah.
And to your point, I think are we one of the 3 states that is touching $1 billion in sales? I'm just wondering.
Um,
I know
in which,
California is.
yeah, California. The other two of those are medical, which are Pennsylvania and Florida.
Oh, got it.
Yeah, and so yeah, both of those are going to be powerhouses. But to your point, and this is the crazy part, not only do consumers pay a lot of taxes, which ultimately go to the state to fund the budgets, but when you think about taxes from an operator standpoint, and we're not touching the plants. I want to be very clear here. We're just simply financing a piece of commercial real estate. But for those operators in the space, there's because they're trafficking in a federally illegal substance, they're paying effective tax rates between 70 and 80% because they can't
Wow.
deduct ordinary business expenses. So it's a difficult area, but even
Wow.
with the taxes, all the other headwinds that are kind of faced, the cannabis market continues to exceed expectations on growth overall. I mean, we'll sell 30 on a national basis. Cannabis sales will be, and this is just legal, $32+ billion in 2024. So this is a huge market and continuing to grow.
So Tom asks, do you feel that cannabis real estate is a solid shorter term investment with the administration that will take office in January? I am 67 years old, but plan to live to 100. Good for you, Tom.
Well, first, we hope you do make it to 100 and maintain the quality of life. That's important.
Good for
So
you.
a couple of things. So it's interesting with the election that we saw yesterday. Certainly, Harris is more or was more pro cannabis than Trump, but Trump isn't anti or restrictive. So the way we look at it is it's going to be pretty much status quo for the next at least 4 years, if not longer. And that's really, really good for what we do because we essentially act as a financing arm, think almost a quasi bank, if you will. So we're providing financing. If there was a scenario where more banks got into the market overall, that creates additional capital. And instead of me lending at 15% to a cannabis real estate transaction, maybe we have to lend at 9 or 10%. And so with Trump taking the White House, it looks as though this for at least another 4 to 8 years has the potential to be a really solid cash flowing investment for our investors. And I would just add to that, one of the benefits with the way I've structured the fund is that we do have liquidity options available. So even if you came in and it was 2 years later, 16 months later, and you wanted to sell, you certainly could do that. Yes, Ramesh.
Question popped up. I know you talked a little bit about Trump, but somebody asks, what do you think Robert F. Kennedy Jr.'s stance is on cannabis? Do you know? Just out of curiosity, I think someone's just asking.
Yeah, no, I mean, so generally speaking, he's not going to pull anything back. He again is kind of in the Trump side where he's less favorable overall, but not a Trump for his side, he actually came out in Florida because he's a resident of Florida and supported Amendment 3, which ultimately didn't pass. We haven't seen that same outspoken support on RFK side, but I don't think you'll see a big pullback. I just don't think you're going to see much movement to the positive. It's got to go to status quo. And again, that's good for us because that continues to provide the opportunity that makes the fund so successful. And quite frankly, this isn't necessarily a 20-year type of play. Once we get legalization or banks get involved, we will see the yields or the costs that we're putting money into the market come down. So that's why we have that liquidity program inside of the fund. And I'm not going to spend too much time on these and know that the takeaway is that cannabis is a really, really big market. And when you look at not only the direct impact of sales, but also the total economic impact, it continues to get bigger and bigger. And again, this is as the total addressable market increases, because you can't cross state lines, you still need that underlying real estate in each unique state that's going to grow, process, and sell cannabis. And I hit on this I just want to put some kind of some visuals on these 2 points for the lack of financing and institutional involvement. So if you look at the banking sector in the U.S., we have just over 4,500 banks. 563 of those accept cannabis deposits, meaning that you're an operator, You sell cannabis, you have revenue, and you're able to income, and you're able to deposit that into a bank. It's less than 50. That number actually is high. It should be less than 25 of those are actually beginning to participate in lending in the space. And it's still a very, very capital constricted market. But even with that capital constriction, you still see tremendous amount of growth in the market. And then for the institutional ownership, I did a comparison, and I think this is interesting. If you look at the top 5 tobacco alcohol stocks and compare that to the top 5 cannabis publicly traded MSOs, which stands for multi-state operator, meaning they're in more than one state, and you look at the average institutional ownership, the top 5 tobacco stocks are about 78% versus the top 5 MSOs, which are about 7% overall. So a tremendous void in institutional ownership. And the reason, quite frankly, is that these aren't easily listed on either the New York or on the NASDAQ. A lot of the public MSOs are listed on the Canadian stock exchanges, which by default have lower liquidity and less institutional involvement. So these dynamics are in place, which really, in my mind, provide enormous tailwinds to the overall industry. And I won't go through all this because I do want to hit on some other important points. But the takeaway is that there are a number of different actions being undertaken, and we know the state legalization didn't go quite as planned with Florida not coming on, but the opportunity for rescheduling and scheduling today on cannabis is a controlled substance, and that controlled substance is a Schedule I narcotic. And that simply means that it's federally illegal, and businesses, and we talked a little bit about taxes, can't deduct ordinary business expenses. So right now, the DEA is set to have a hearing. It was originally scheduled for December 2nd. That got pushed back to early 2025, where they're looking to reschedule cannabis from a 1 to a 3, which means those operators would be able to deduct ordinary business expenses. And for us, that's really a Goldilocks scenario, because now our operators become more profitable, have more income to meet interest obligations, and become a better credit quality borrower. And so we're very optimistic on the future of our borrowers and the overall market. Okay, so where are we? We're at 2:32. I want to spend some time now really diving into MJ REIT and the value proposition that we have. So I won't go through these in particular in detail, but know that you're very, very much focused on maintaining a stable net asset value and generating an attractive above market income, which is distributed to our investors on a monthly basis. We really want investors to consider this for one of two areas within their portfolio. One is a diversifier on the real estate side. So maybe you have exposure to multifamily, maybe parking garages, maybe residential, maybe commercial. We fit nicely as a diversifier within that particular bucket. Or conversely, on the income side, where we can be used as a fixed income alternative because of our above market 10% plus goal of generating that monthly double digit passive income. So we've taken the best side from both the public as well as the private side, and we put them together in MJ REIT. The main focus of our fund is to underwrite senior secured mortgages, 2 to 4 years in maturity. These are not 30-year mortgages. And the reason that we don't go long dated is, quite frankly, I don't know what is in store for the cannabis market in 10 years, but I feel relatively certain that we have a good idea over the next 2 to 4 years. So they're short-term in nature, and that also reduces the risk inside of the portfolio. So we're underwriting senior mortgages, short-term in nature, and we're putting money into the market today between 14 to 16%. And while that sounds very expensive, these companies can be very profitable, and there's not a lot of capital available. So we're one of the few names in town that are actually still participating and providing capital to this area of the market. Yeah, I won't belabor this one because this is kind of outside of the IRA, but because we are a REIT, there is in a non-taxable account, there is a tax benefit for this, and that's the 20% deduction off of federal taxes.
But
Yes.
I just understand, Chris, when I talk to IRA club members, I know that IRA club strictly focuses on retirement dollars, but that doesn't mean anything to IRA club, right? We're here to educate you on, again, what's out there, different strategies. So I don't care if you use your personal dollars or your retirement dollars. The goal is to get you to think outside the box. So although you may not want to use retirement dollars and you want to use personal dollars for this, feel free. I mean, that's what I wanted to drive home, Chris. Even though you're showing this,
Mhm.
it's here nor there for us. You are an IRA club client. The majority of you that are listening, we want you to see what's out there, and that's why we host these webinars. So if you want to use personal dollars, feel free.
Yeah, and the kind of upside on the personal dollar standpoint, going back to that deduction off of federal taxes, and that's because we're taxed as a REIT. On the left side, I just show a quick example. You know, if I distribute a 10%, and it's in a taxable account, your taxable equivalent yield would be at 11.2%. Interestingly, and if you look at the chart on the bottom right, I've shown here our annualized distributions on a monthly basis since inception. So on the low side, just over 10%, and on the high side, up to 16.67. Our distribution for the month of October, we haven't announced it officially yet. We'll pay it next week as we pay our distributions by the 15th following month end. We'll distribute that next week, and it looks like it'll annualize somewhere north of 15%, 1.5. And the reason for that, if you look at March of 24, it was at 15.5. May of 24 was at 16.7. You know, because of that scarcity of capital, we can often negotiate as part of the loan package some sort of additional enhancement. And we did that with 5 properties in the state of Ohio back in 2022. 3 of those sold, one in March of 24, one in May of 24, and one in October. And because we're a REIT, we pass through all of our income to our investors. And when we have an opportunity to distribute more capital, more income, we certainly do that. And that's reflected in those 2 kind of spiked months that you see. But from an expectation standpoint, we really focus on a 10% annualized, monthly income. You know, we're going to get higher than that. That's the goal. But I'd rather tell you 10 and deliver 11 than tell you 11 and deliver 10. So that's the stated goal. From a performance standpoint, in the month of September, our distribution annualized at 11.28. Our since inception return as of the end of September was 11.01. And a $100,000 investment would, at our inception, would have grown to $125,951. So strong performance, and that performance is mainly derived from the consistent double-digit monthly annualized income. So that's the fund overall. But how do we really find these deals and look at the investment committee that I've put in place to analyze these particular deals? And what I want to drive home with this is that these individuals have been in real estate their entire careers, and they have focused on thematic investing through their entire years. So our investment committee, which is 7 members, all seasoned, with a combined 200 plus years of experience. And I can't stress enough, I mean, these are what I would refer to as old school guys. I mean, they still get out while they have access to computers, but they get out the pencil and paper, and they just go through, and they're meticulous on their diligence and their focus on downside protection, which is vital in what we do. Because of the market overall, that lack of capital, there's a tremendous amount of deals in the marketplace, which allows us to be extremely selective on those deals that we fund. So for every 100 transactions or potential deals that we look at, we're going to finance less than 5% of those. And in particular, we typically would finance between 1 and 2 of those deals. So point being is that we're very, very particular in our underwriting process. And this slide is meant to be confusing. You know, this is how we source the deals, right? We have a number of different avenues by which deals come to us. And we have a very methodical investment process and diligence process, again, to ensure that, number one, it passes all of our certain criteria, as well as ensures that from a risk mitigation standpoint, what can go wrong, and we factor that into our overall analysis to ensure that the investments that we're funding are as mitigated on the risk side as possible. And I want to leave you with this thought of how we do what we do. So if I was to step back and look at the biggest risk in what we do, it's really the V in loan to value, because we're underwriting a loan based on the valuation of a piece of property. Let's say that Ramez and I get together and we buy a building for $2 million and we put $6 million in improvements. So that building now in our mind is worth $8 million. And there were other firms in the marketplace that would come close to that $8 million valuation. But when you look at what we do, we use an alternative use valuation methodology. So we provide no additional enhancements on that $6 million in this example of improvements. So we would come in and underwrite a senior mortgage, lend 70% on that $2 million valuation, even though we'll include that $6 million in cannabis improvements in our collateral package. Can't stress this enough. This is the most important aspect of what sets us apart, and it's critical to our risk mitigation and everything that we do. Real quick, and how much time do we have left, Ramez?
Oh, you're good. You got about a good solid 7-8 minutes.
Okay, perfect. So it's important that we're able to put money into the marketplace, but really a question that I often get is, well, I hear you, Chris, but how do you actually get that money back? How do you get that principal paid back? And there are a few different ways that we get paid back. The first, and this is what happened in those months where I showed that big spike, is the building or property is sold and we're paid off with the proceeds. Second, I told you we underwrite these mortgages between 2 to 4 years. So let's say we have a 3-year mortgage that we underwrote with Ramez. In 3 years, his business is doing better. He has 3 more years of operational history, and he can go to potentially another lender and refinance us out, which is the kind of the second way we get refinanced out. Third is the borrower generates enough from being successful for free cash flow and ends up paying the loan off, or finally, they might raise some equity dollars, and as part of that equity raise, we get paid off on the debt side as well. So very, very important to how we get paid off. The majority of these are we've got paid off from the borrower selling or refinancing us out at a lower rate. Deals, I'll just touch on this. We have a large pipeline, which is important, going back to the number of deals in the marketplace. Current pipeline exceeds $100 million in deals that we're currently reviewing. The team overall is seasoned professionals. Myself on the right, my Chief Revenue Officer, Gopa Dobson, on the second from the left. I guess I'm on the left too. I said right. Second from the left, Kyle Schenfeld, Matt Gould, and Ben Bolanos, also very seasoned. And this is the team that focuses on the diligence, going out, visiting in those sites, ensuring that proper docs are in place before orchestrating or originating those deals. And so, this is the senior leadership team that we have in place. And then hopefully by now, if I review these kind of 3 components, it stands out, and you would agree with me when I say this. If I had to summarize what we just talked about into 3, let's call them just 3 uniques, right, Ramez? So what sets us apart? Really, first and foremost is we get cannabis real estate. This is all we do, and I will tell you, cannabis real estate is different than multifamily. It's different than movie theaters. It's different than everything else on the real estate side nationally. So understanding not only the real estate market, but understanding the dynamics within the cannabis market gives us a leg up, and that's our sole focus of providing capital financed by commercial real estate within the cannabis sector. Second is that we've done this before, and actually one of the properties sold, so it's 25 properties today. So we've done this before, meaning that this isn't something new. We have 25 properties across 5 states. Every deal is voted by a 7-member seasoned investment committee before it gets into the portfolio. So it's the cannabis aspect, It's the idea, our notion that we've been doing this, we've done this before, and we'll continue to diversify the portfolio. And lastly, and this is probably most important, is that we dislike downside. And going back to that $2 million versus $8 million valuation, our fund is set up to compensate investors for the risk of cannabis without actually taking that risk. And I say that because, we're financing it at that $2 million valuation, not at the $8 million valuation, but we're still getting compensated for the risk, for taking that risk, even though we're not actually taking that risk. And so that's really the three uniques that set us apart, is that we get this area of the market, we've done this before, and most importantly, we dislike downside risk. Quickly on performance, I showed the annualized numbers. We do price the fund on a monthly basis. We started at $25 a share. We ended October at $25.16. So I don't want you to expect to see the fund go from 25 to 30. That's not the goal of the fund. The fund is the stability in net asset value, so going from 25 to $25.16. But really where you're going to earn or have the potential to make an above market risk adjusted return is through that monthly income that we're distributing. And you'll see I've highlighted that on the top, which coincides not only with the income, but any price appreciation as well. So what stands out to me in here is the consistency of the NAV and the above market income that we've been paying to our investors. And then lastly, why do investors allocate to us? And there's really four buckets on this. One is, they want that cash flow, consistent double-digit monthly cash flow that we've paid out since inception. Maybe they're looking to diversify their portfolio. Back to my earlier point with maybe your portfolio has a lot of public assets in it, and you're looking to dampen that portfolio. Although yesterday, that 1,500 plus rally didn't hurt, but it doesn't always go up, right? So dampen that, diversify that portfolio, dampen the volatility, and also with the enhanced tax benefits from investing through non-retirement dollars. We do have an independent board of directors. I'll put this up very quickly. So the takeaway here is that it's seasoned professionals, all have spent their entire career in the financial services space, most of those spending a substantial amount of time in the real estate side. Our goal here today is really to provide an overview and hopefully pique some interest in what we believe is an opportunity that won't be around forever. And that's why, again, we've designed the fund to have that liquidity option available, but it's really taking advantage of what's in the market today and an area that is differentiated from other areas of the U.S. economy. So this investment is not for everyone's portfolio. We do believe that from a diligence standpoint, it is important to look at the underlying fund, and we're happy to jump on a call with you because at the end of the day, we want to help you build out a diversified portfolio. And whether you use MJ REIT or another option, we'd like it to be us, but we understand. And if we can play even a small role in your allocation, we would be happy to have a conversation.
Thank you, Chris.
Thank you.
The information contained herein is intended to help the viewer successfully navigate common IRS and Department of Labor requirements to help achieve successful results from their IRA. The information is not intended to replace information from your legal counsel or income tax professional. IRA Club does not offer or sell any investment. All investments have risk.